Welcome to the Deep Dive. Today we're unlocking the financial narrative of Radiant Logistics, Inc. That's ticker RLGT.
Right. We're digging into their recent discussion covering the fourth fiscal quarter and the full fiscal year, which ended back on June 30th, 2025.
And this one caused some ripples, didn't it? The call on September 15th seemed to send some, let's say, mixed signals into the market.
Yeah, definitely a volatility event. It was a classic situation, a really strong beat on the bottom line, but then, a slight miss on revenue and maybe a more cautious outlook than people expected.
So our mission today is to synthesize all that. Look at the headline numbers, what CEO Bon Crane and CFO Todd McCumber actually said about strategy, and figure out if this M&A story is holding up against these macro pressures.
Exactly. Is the compounding engine still running smoothly?
Okay, let's start right there with the immediate reaction. The stock had actually been doing pretty well leading up to the call, then bam, hit hard right after. What were the headline numbers that caused that kind of whiplash?
Well, it was definitely a split decision, and it seems the market initially only really cared about one side of it. The good news first. Q4 adjusted EPS came in at $0.11.
11 cents. Wow. Okay.
Yeah, which was, a massive operational win. It basically doubled the consensus estimate, which was around $0.05.
Okay, that really does signal strong efficiency, good cost control. Something's working well there.
Yeah.
So why the dip? What spooked the market?
It seems it was the top line. Q4 revenue clocked in at $220.6 million. Now, that's a big number, but it missed the street's forecast of $224.1 million.
Yeah, okay. How much of a miss was that?
Just about 1.6%. Not huge in percentage terms, but, that slight miss combined with management sounding a bit cautious about trade policy, well, that seemed to be enough.
Right. Triggered a strong negative signal. What did that look like?
Pre-market trading indicated the stock was down something like 8.4% compared to the previous close. It just shows how sensitive things are right now.
So the takeaway was volume and outlook concerns trumped that really significant EPS beat. But, if we pull the lens back a bit, look at the whole year. Doesn't that tell a different story, a stronger one?
Oh, absolutely. That's the bull case, right? Zooming out to the full fiscal year 2025, things look, pretty robust. Full year revenue hit $902.7 million.
And the growth there?
That's up a very healthy 12.5% year over year. And maybe more importantly, full year adjusted EBITDA came in at $38.8 million. That's up 24.4% compared to last year.
Okay, wait. Revenue up 12.5%, but EBITDA up over 24%. That implies something pretty critical about how they're operating, doesn't it?
It really does. It points to successful compounding, like we talked about, and really strong integration discipline after their acquisitions. They actually reported margin expansion across the board.
How much expansion?
Their adjusted EBITDA margin increased by a full 300 basis points, hit 16.2%.
Wow.
Yeah. So that tells you, they aren't just getting bigger by buying things. They're actually getting significantly more profitable with each dollar of revenue they bring in.
Okay, so we have this backdrop. A really successful year overall, strong compounding, margin expansion. But then this Q4 speed bump with adjusted EBITDA and net income both down year over year for that specific quarter. What did management say was the core reason for that dip?
They pointed pretty directly at a macroeconomic headwind, specifically tied to trade and tariffs. Bon Crane used the phrase lack of pull forward.
Lack of pull forward. Okay, that sounds a bit like industry jargon. Can you break that down for us? What does that actually mean?
Sure. Think of it like this. Imagine everyone knows tariffs are going up on, say, imported widgets in July. What do businesses do in May and June?
They buy widgets like crazy before the price goes up. Pull that demand forward.
Exactly. They pull it forward. So Radiant saw some of that earlier in their fiscal year. Customers were trying to get ahead of potential U.S. trade deadlines, maybe tariff effective dates. That created this sort of artificial demand boost earlier on.
So Q4 was the other side of that coin, the quiet after the storm.
That seems to be the explanation. It was the period where inventories maybe got drawn down after that initial surge. So it wasn't necessarily a fundamental problem with their business model, but more a consequence of their customers reacting to policy uncertainty. Busy Q3 meant a quieter Q4 kind of thing.
Okay, that makes sense. And it sounds like management expects this kind of choppiness to stick around for a bit.
Yeah, they were pretty clear about expecting near-term volatility from these trade and tariff dynamics. But, their positioning seems to be long-term. They stressed wanting to remain nimble.
Nimble for what?
So they're ready for what they see as an eventual surge in global trade once these disputes hopefully get resolved. They're riding out the waves, but keeping the ship ready.
Right. Okay, let's pivot then to the growth engine that seems most central to their story, especially long-term. The M&A playbook. You called it an M&A-enabled roll-up. For listeners maybe not deep in logistics, what does roll-up mean in this context?
So a logistics roll-up, it's basically when a central company like Radiant buys up smaller, often privately owned local or regional logistics players. These could be agency partners they already work with or totally new companies' greenfield locations.
And the goal isn't just size.
No, not at all. The key is integration. They bring these acquired businesses onto Radiant's centralized platform, think IT systems, back office functions, maybe negotiating power. This creates big efficiency gains, gives the smaller guys access to better tech, and ultimately expands margins.
Which connects back to that 300 basis point margin expansion we saw. Proof the integration machine is working.
Exactly. It shows they're not just buying companies, they're making them more profitable as part of the network.
And they were definitely busy on the M&A front in fiscal 25, weren't they? You mentioned green fields like Cascade in Seattle, Foundation in Houston, TCB in St. Louis, Transcon in LA, and then partner conversions too, like Select in Miami, USA Logistics in Philly.
Absolutely. And, the specific names maybe matter less than the overall strategy, which is network densification. They're filling in the map, building scale in key markets.
And these deals are actually contributing.
Oh, yeah. Management said those acquisitions contributed about $6 million to adjusted EBITDA for the full fiscal year. That's real, tangible growth coming from the M&A, even while the broader freight market might have been sluggish. It shows the strategy can work somewhat independently of the cycle.
Okay, and speaking of strategic moves, probably the biggest M&A news was locking down their platform in Mexico, right? The Weport deal.
Yes, the Weport acquisition feels like a cornerstone piece for the long-term thesis. They bought an 80% stake effective September 1st, and they explicitly framed it as the foundation to scale their whole North American footprint.
And the driver there is nearshoring, capturing that manufacturing shift.
That's exactly the narrative. It's positioned to capitalize on those manufacturing flows, potentially moving closer, out of Asia and into North America, particularly Mexico.
Is there any nuance to Weport's business? Is it all just trucks crossing the border?
That's actually a really good clarifying point. Management made sure to say that Weport's existing business was primarily focused on true international air and ocean freight.
So not just border traffic.
Right. It means they're acquiring sophisticated international logistics expertise based in Mexico, not just a trucking company that happens to cross the border. It diversifies their exposure within Mexico and potentially helps capture global trade coming into the continent via Mexico. It seems like a smart way to avoid being overly dependent on, say, just the trans-Pacific trade lanes.
Makes sense. Okay, this M&A engine obviously needs fuel, lots of it. Let's talk liquidity. How does the balance sheet look after buying Weport? How much dry powder do they actually have left?
Well, this is arguably one of the strongest parts of their whole story right now. They reported $22.9 million in cash on hand. But the key number is the credit facility.
The revolver.
Yeah. They have a $200 million revolving credit facility, and they've only drawn $20 million on it.
Wait, hang on. Only $20 million drawn on a $200 million facility. So they have $180 million in immediate available borrowing capacity.
Pretty much, yes. It's a huge amount of dry powder, especially in a market where deals might be getting cheaper, and given how active their M&A pipeline sounds.
What's the plan for that capacity? Are they just sitting on it?
No, their plan seems clear. They use the phrase relever prudently. The goal is to use that capacity to fund more of those partner conversions, find more synergistic tuck-ins, and also continue their stock buyback program.
They did buy back some stock in FY25.
They did, about 145,717 shares for roughly $0.8 million. So they're active, but it feels disciplined. And they set a target for leverage.
Let's target.
They said a normalized target for net leverage would be around 2.5 times EBITDA.
And they made a point of comparing that to others, didn't they?
Yes, they explicitly mentioned they wouldn't chase the higher leverage ratios, 4, 5, even 6 times that maybe some competitors, especially those backed by private equity, might be using. It signals a focus on managing risk, steady compounding over maybe a riskier, highly leveraged bet.
Okay, let's switch gears slightly. There's a detail, sometimes buried, but important for future earnings. The amortization step down. How does that work? And why should investors care?
Right. This is a good sort of aha moment if you're modeling the company. D&A, that's depreciation and amortization, the amount they expense each quarter, is set to drop significantly. down to around $3.6 million a quarter.
Why the drop?
It's purely mechanical. Back in 2015, they made a big acquisition, the Wheels Group. The accounting rules meant they had to amortize certain intangible assets from that deal over typically 10 years. Well, those 10 years are up.
So that expense just vanishes from the P&L.
Essentially, yes. The amortization related to that specific deal expires. Now, remember, amortization is a non-cash expense, so this doesn't actually change their cash flow or their EBITDA.
But it does impact net income, right?
Exactly. For anyone valuing the company on an earnings multiple, like a PE ratio, lower amortization expense flows directly through to higher GAAP net income and higher adjusted net income in the future. It's almost like getting a structural boost to reported profitability, even if the underlying cash generation hasn't changed purely because of this.
That certainly makes that Q4 EPS beat and the potential for future earnings growth look even more interesting. Before we jump into our hypothetical trade idea, management also seemed pretty excited about technology.
They did. They talked quite a bit about rolling out a collaboration platform technology. This apparently came from the Navigate acquisition they did a while back.
And the goal isn't just having tech, but using it strategically.
Right. They framed it as a way to increase wallet share, getting more business from their existing customers by giving them a better, more integrated tech experience. It shows they're focused not just on buying new network pieces, but also optimizing the network they've already built.
Okay, so summing up the sentiment. Management seems braced for a maybe muted peak shipping season because of the macro stuff, but the core focus remains squarely on M&A and network growth. Connecting that back to the market reaction, it really does feel like maybe the street got spooked by the short-term noise.
Yeah, it feels like the initial sell-off might have over-indexed on that temporary trade headwind, perhaps overlooking the full-year compounding story and that, frankly, enormous balance sheet flexibility.
Nice. Let's shift gears then. Time to put on our completely hypothetical, this is not financial advice, hedge fund analyst hats. Let's cook up a trade idea based on this call.
Slight pause. Okay, let's do it. Fire away.
So the basic premise is this. The market seems fixated on the Q4 softness, the tariff fears. It's maybe ignoring the impressive full-year EBITDA compounding, the margin expansion, and importantly, that huge pile of low-leverage dry powder. We need to play that divergence.
Okay, so what's the core proposition? What's the bet?
Well, the bet is essentially on management's M&A execution. It's a bet that their disciplined acquisition strategy, combined with the structural tailwind from nearshoring into Mexico via Weport, will overcome this short-term macro noise. RLGT might actually be built to generate alpha because of the sector choppiness, not despite it.
Interesting. How do you structure that? What's the actual trade?
Okay, so the idea would be go long RLGT shares, but couple that with a short position in a broad transportation ETF, something like XTN, which holds a basket of more generic transport stocks.
Right, a pairs trade. What's the rationale for the short leg?
The rationale is that RLGT's specialized M&A-driven model, plus the complexity of integrating these diverse businesses, creates a bit of a moat. It could insulate them somewhat from the really big swings affecting the general freight cycle, where many companies in an ETF like XTN Live. So you're betting RLGT outperforms the broader sector.
Exactly. We're basically banking on management using that $180 million in dry powder to make, say, 2 or 3 more really smart, accretive acquisitions relatively soon. If they do that successfully, it could force the market to reevaluate RLGT upwards, even if the overall transport index is still kind of struggling or flatlining.
That's a classic divergence play, betting on execution and specific company strategy against the general sector trend. It hinges heavily on their ability to integrate well and turn that liquidity into earnings power quickly.
Absolutely. High conviction, but definitely execution dependent.
Okay, so wrapping up, Radiant delivered what looks like a financially strong fiscal 2025 overall. You had significant growth in EBITDA, driven by acquisitions, and really impressive margin expansion.
Right, but the Q4 results definitely highlighted that macro vulnerability, especially around trade uncertainty. The narrative going forward really seems to hinge on 2 things: continuing that disciplined M&A playbook, and successfully building out that North American footprint, especially with Weport in Mexico.
They basically built a machine designed to find and integrate deals, hopefully compounding value through the cycle. And crucially, they seem to have the capital structure right now to keep running that machine pretty aggressively if they choose to.
Yeah, the pieces seem to be in place.
Okay, so here's the final provocative thought for you, the listener, to chew on. Radiant is sitting on this huge chunk of undrawn debt capacity, all right, $180 million. And they're publicly targeting a relatively conservative leverage ratio of only 2.5 times EBITDA. Given their active pipeline and their stated goal to re-lever prudently, Just how transformative could one single, maybe larger than usual tuck-in acquisition be? One that uses, let's say, half of that dry powder. And how quickly could an announcement like that shift the market's view of this stock from maybe cautious or uncertain to real conviction?